exam 2, which is available on the ICAEW website. So we're going to practice question 1 on the ICAEW software. So question 1 is a question on expected value, a question on investment appraisal, which is the computation of the NPV. We are going to have capital allowances computation, working capital computation. So we are going to do 1.1, which is using money cash flow to calculate the expected net present value of the Waterworld project on 30th of June 2019, which is the current day, and advise Blue Sky's board whether it should accept the project. So this is a 16 marks question. Right. If we get back to the question itself, you would see that you should assume that the current date is 30th of June 2019, which means that this is year 0. So what we can do on our software, we can already have our year 0 here. So we can include it at Y note. Yeah, Y note, here it is. So this is 2019, right? Blue Sky Entertainment plc is a company listed on the London Stock Exchange which operates entertainment facilities throughout the UK. Blue Sky is seeking to diversify and expand its activities by opening a new aquatic adventure park called Waterworld and has asked a market research company for a fee of £100,000. Right, so you would see that this market research fee has already been undertaken prior to the project, so this is a sunk cost which is ignored in the computation. But it is worth noting that if you don't include it as your answer, you're going to lose 1 marks for that. So you should say, for instance, so we are going to include it here, for instance, just to leave enough space for the NPV computation, we're going to say that the market research fee is a sunk cost and therefore ignored in the computation. Here you show that you are going to get your 1 mark. Get back to that. So to estimate the number of visitors, the market research, etc. So we can have a look at it here now, the number of visitors and the associated probability, right? So once you have this kind of question, what you need to know here, we need to calculate the estimated or expected number of visitors based on the number of visitors and the associated probability. This is what we call the expected value. So we have the number of visitors on one side, so the number of visitors on one side. So still this is a working number of visitors on one side. The associated probability on the other side, right? So the number of visitors is 12 million. We're going to have that here. 12 million, 1, 2, 3, 1, 2, 3. 9 million, 1, 2, 3, 1, 2, 3. I like to talk when I say the numbers because just to make sure that you include the exact number of zeros. 6 million, 6, 1, 2, 3, 1, 2, 3. Here you go. So the associated probability 50%. So it's 0.5, 30%, which is 0.3, and 20%, which is 0.2. Now bear in mind 2 things. The software does not understand percentage, so it's worthless to include percentages in your workings. Always include percentages as decimal. For instance, 50% is 0.5. The second thing to bear in mind is that here I need to increase the decimal to 2 places, but in the software in exams, for exam purposes, the number of decimals will already be at 2 decimal places. So your answer will already be at 2 decimal places. Right? The expected value here is this multiplied by this one. It's this one multiplied by this one, and it's this one multiplied by this one. Here you go. So the total expected value is the autosum of that, so is equal to autosum. Here you go. This is the expected value of visitors, and this is what we are going to use for our computations. It says that the forecast growth for the associated numbers now it says that in the first year to 30th of June 2020, this is the first year, and the forecast growth for the next 3 years, which means that if we get back to our workings, you have got next 3 years, which means that you have got year 1, this is very important to understand, year 2, and year 3, which is the next 3 years, which means that this is 2020, this one is 2021, and this one is 2022, right? So next 3 years, bear in mind that we have got year 4 as well, so this is 2023. So this is your one where you have forecast the expected value for number of passengers, and the next 3 years, which means that you have got year 2, year 3, and year 4, right? So we can just put it in the proper alignment. Here you go. So this is our format that we are going to use. Visitor numbers in the following 3 years to 30th of June 2023, this is what we included here, would remain at the first year's expected level, adjusted for 5% growth. So if we get back to here, we are going to have year. So we are going to have our year here. We are going to have year 0 is here, year 1, year 2, year 3, and year 4. The number of visitors that we are going to include. So in the first year, the number of visitors is already given, which is this value of 990,000, right? Which is based on the expected value. And as from year 2 onwards, it says, I repeat again, here you go. Visitor numbers in the following 3 years would remain at the first year's level, which is 990,000. Adjusted for 5% growth. So you include it directly, which is equal to this multiplied by 1.05, equal to this multiplied by 1.05, and equal to this one multiplied by 1.05. Here you go. Right? So this is the number of visitors. You are an ICAEW chartered accountant. You intend to appraise the project at the current date, which is year 0, using the net present value. The estimated sales revenue will be 34 in the first year. After 30th of June 2020, which is the first year, sales revenue per visitor is expected to increase by the general inflation rate of 2.5%. So very good. We have got here the selling price. So the selling price in the first year is mentioned is 34. After which is going to grow by 2.5% per annum. So it's equal to this value multiplied by 1.025 is equal to this value. 1.025 is equal to this value multiplied by 1.25. Right? So we can calculate what is known as the revenue. So revenue in this case is this multiplied by this one. Bear in mind that you can't copy and paste formula in this case, or just drag the formula like you do in Excel. The software does not allow you to do this, so you have to calculate them separately. It does mention as well that the contribution is 40% of sales. So if we get back to that, we have got contribution, which is 40% of this value multiplied by 0.4 equal to this multiplied by 0.4 equal to this multiplied by 0.4 and equal to this multiplied by 0.4. Right, so this is the contribution, and this is the first working that we are going to include in our, we just Control C, select Control C, Control V, bear in mind to paste as from year 1 because you're not going to generate any revenue and hence contribution in year 0, so we can include that as working 1, and coming back down we can write this down as here you go, this is working number 1. We continue. Incremental selling and administration expenses in the year to 30th of June 2020, again this is year 1, are estimated to be 90 million in year 1 and increase at the rate of 4% thereafter. So we are going to call that incremental cost, incremental overheads. Given that it is an incremental cost, it is therefore relevant. It is 90 million in the first year, right? So it is 90 million, 90, 1, 2, 3, 1, 2, 3. We're going to include it as negative because it is an outflow, right? And then it's going to grow by 4% thereafter. So it's just equal to this multiplied by 1.04 is equal to this multiplied by 1.04 and equal to this multiplied by 1.04. So this is the incremental overheads. We continue. On 30th of June 2019, the project requires an investment in working capital. We are going to take working capital later on. Bear in mind the format is sales revenue, less all the variable costs, get your contribution, less all your fixed costs and any relevant expenses, get your taxable profits, tax the profits, and then you start with working capital. So this is the initial investment, this is working capital, this is the weighted average cost of capital. So here you go. I think that's it. So we do have a subtotal to include here. So we include a bottom line, and then we are going to call that, I used to call it taxable profits, because this is profits effectively, right? So we select this, calculate the autosum, select this one, calculate the autosum, select this one, calculate the autosum, and select this one. So sometimes it just does not pick up. So you just have to try again. Here you go, this is taxable profits. Unless stated otherwise, the cash flows arise at the end of the year. And then it does mention as well the tax rate. Yep, assume that the rate of income tax is 17% and arise in the same year. Normally for ICAEW ACA questions, tax will arise in the same year as the cash flows arise. So we apply the tax at 17%. Tax at 17%, and it's going to arise in the same year is equal to minus, because tax is an outflow, multiplied by 0.17 is equal to minus, select the taxable profit, multiplied by 0.17 is equal to minus, multiplied by 0.17 is equal to minus, multiplied by 0.17. Right, no need to make any subtotal. Now you can include them directly. We get back now. Point number 1 is done. Point number 2 is done. Now we move on to point number 3, which is about investment in working capital. Bear in mind that the relevant cash flow is not the working capital itself, but rather the changes in working capital. Any increase in working capital is an outflow, and any decrease in working capital is an inflow. So we have to do a working number 2 for working capital. So getting back to that, working number 2, again, we have got year 0, no need to write them again, right? We write WC, which is working capital. On 30th of June 2019, the project requires investment in working capital at 35 million. So in year 0, 35, 1, 2, 3, 1, 2, 3. So this is 35 million in year 0. And then it says it will increase at the start. This is very important, at the start of each year. It means that when a cash flow occurs at the end of the year, you're going to include it in the year itself. Just to give you an example, if a cash flow occurs at the end of year 2, you're going to include it in year 2. But if a cash flow occurs at the start of year 2, you're going to include it in year 1, right? And that's why working capital starts in year 0 anyway. In line with sales volume growth and sales price increases, right? Bear in mind that the sales volume growth, number of visitors used to increase by 5%, 0.05. And selling price, based on our equation, was increased, inflated by 2.5%, 0.05, right? So this is the growth in selling price and the growth in number of visitors. So which means that the working capital is going to grow at that particular rate 1.05, which is the growth in sales volume, multiplied by 1.025, which is the growth in selling price. Here you go. This is the working capital in year 1. Again, it's going to grow by 1.05 and then grow by 1.025. This is year 2. Is equal to this one multiplied by 1.05 multiplied by 1.025, right? And bear in mind that in year 4, your working capital is going to be 0. The assumption here is that working capital will be fully recovered, which I think, yep, fully working capital will be fully recoverable in the final year. Now we are going to calculate the changes in working capital. Now the change here, it has increased by 3.35 million, sorry, because it was 0 initially. Here it's this value minus this value. It's this value minus this value. Again, the changes in working capital is important. This one minus this one. It's this one minus this one. Right? Now the effect, an increase is an outflow. Just write it down for you to understand. This is an outflow increase, outflow increase, outflow increase. This is a decrease, so it is an inflow. So you can write it here. Given that it is an out, it should be included as negative. It is an out, it should be included as negative. It is an out, it should be included as negative. Out included as negative, and in included as positive is equal to minus and then open bracket. You see, it's mismatch if you write is equal to minus and just select the number. Is equal to minus, open bracket, include the number, and then close the bracket. Here you go. And bear in mind that the sum of working capital should be equal to 0. Just to confirm, here you can write the auto sum. Here again, it's 0 for working capital. And now you just copy and paste. So you copy from year 0 up to year 4, Control C. This is the changes in working capital. Paste it in Control V in our computation. Here you go. We continue. On 30th of June 2019, which is year 0, the project will require an investment in land of 40 million and plant and equipment of 500 million. So this is the initial investment. You have got two investments here. You've got investment in land and you got investment in plant and equipment, right? So the investment in land is 40 million. It's going to arise in year 0, negative 40, 1, 2, 3, 1, 2, 3, which is an outflow, and negative 500 million, which is an outflow again. So negative 500, 1, 2, 3. 500, 1, 2, 3, 1, 2, 3. So negative 500 million. Here you go. It is estimated at 30th of June 2023, which is the final year, the land will have a resale value of 80 million. So this is an inflow in the final year, 80, 1, 2, 3, 1, 2, 3, 80 million. And the plant and equipment will have a value of 120 million. So 120 million, 1, 2, 3, 1, 2, 3. Right. So here you go. This is the residual value, which will be an inflow. The plant and equipment will attract 18% reducing balance capital allowance in the year of expenditure, which means that you start calculating capital allowance in year 0 itself, except in the final year. Now, bear in mind, for capital allowance, it is not capital allowance in itself that is important, but rather the tax relief on capital allowance, which is important. We are going to include that as working number 3. So getting back to our working now, you would see that I have left quite a significant amount of rows for the computation. This is so because you will understand that in the software, if you add rows, all the formulas will get disrupted. That's why I will strongly advise you rather not to include rows at all whenever you're doing calculations questions, because this will disrupt the formulas and of course disrupt the calculations as well. Right, so working number 3 is about capital allowance, which is claimed on the plant and equipment. So the cost is 500 million. Yep, just to confirm, yep, 500 million. 500, 1, 2, 3, 1, 2, 3. You go. You claim capital allowance in year 0 itself. It's 25%, no, 18%. So it's 18% is equal to this multiplied by 0.18, right? You make a subtotal because it's on a reducing balance method. You claim capital allowance in year 1, which is equal to this multiplied by 0.18, right, is equal to this minus this. You claim capital allowance in year 2 is still on a reducing balance method, which means on the written down value multiplied by 0.18. Again, you make a subtotal after each capital allowance. And just to ease calculation, please don't include those figures as negative. We're going to include them as negative or positive afterwards, but don't include them as negative. Do we claim capital allowance in year 3? Yep. it is equal to this multiplied by 0.18, and the tax written down value is this minus this. The final year, which is your 4, we don't claim capital allowance, but rather we are going to compare this tax written down value with the sales proceed. So the sales proceeds, which is the residual value, you call it, and like this, the residual value or the scrap value, as you may call it. The scrap value was 120 million in the final year, so it's 120, 123, 123. Here you go. So you end up with a balancing allowance. So a balancing allowance is the same as a loss on disposal, right? Now you see that the tax written down value is that much, 226 million and something, whereas the sales proceeds is 120 million, which means that if you decide to sell it at 120 million, you make a loss on the disposal, which we call that a balancing allowance. Let's say that you have sold it at a value which is higher than this value, which is the tax written down value, then you would have made a balancing charge. Now, this is not really important, but what is important is the tax relief on those capital allowance, right? So we're going to just include that here. You'll see that I don't really like to use borders or bottom line. You're going to use it as well only when it is necessary to do so. Here you go, right? So we're going to call that tax at 17%. So equal multiplied by 0.17 equal this one multiplied by 0.17 equal this one multiplied by 0.17 equal this one multiplied by 0.17 and equal this one multiplied by 0.17. Yep. Now, if you had a balancing charge, then this would have been as negative, which means that you would have paid tax on a profit at disposal, but you get a relief on a loss on disposal. Now, you would see that we have to copy and paste all these values in our computation as tax relief, as positive value, as inflows. The simple way to do it is just to include it here first on an horizontal basis. There you go. Here you go. And here you go. Yep. So this is from your 0 up to 4, Control C, and then you're going to include them here as Control V. Here you go. So this is positive because it is a tax relief. I repeat again, only in your 4 this could have been a negative value if you had a balancing charge. So we are done with this point as well. This is what is said. So in all questions going to inform you about that, a balancing allowance or a balancing charge, recovered tax. This is the discount rate. You're going to use that in a while. The last point for that computation, you intend to include in the NPV a continuing value at the end of 4 years that will represent the value of net cash flow of the tax beyond the 4th year. This will be calculated as a multiple of 9 times the expected after-tax operating cash flows for the year ended 30th of June 2023, which is your 4. Now, it says the after-tax cash flows. Now, you understand that the after-tax cash flows is the sum of this and this, which is the taxable profits, okay, minus the tax. Assuming no depreciation in the question, right? The tax, this profits would be equal to the cash flows. So this is the cash flows, and it says that it's going to have a terminal value of 9 times multiplied by 9 of 9 times the this value. You're going to call that a continuing value. So here you go, you're going to call that a continuing value which arrives at the end of your 4. That's why we include it in your 4. So here you go. You make a subtotal, you're going to call that the net cash flow, right? So again, you're going to select that, select the loss row as well, though it is blank, right? Because you know what's going to happen if you don't select this blank row, the subtotal will be included here rather than here. you select this. Sometimes it just doesn't pick up, so you're just going to try again. There you go. We try again here. Here you go. Try again here. You see it doesn't pick up, so you just have to select again. Those kind of stuffs, you have to get used to that, because this is how it's going to be in exams as well. Sometimes it will pick up, so when it doesn't pick up, you just select any cell and then select them again. It will definitely pick them up, right? So what discount factor are we going to use? It has a money weighted average cost of capital, so no conversion is needed, because we're already using the money cash flows, that is the inflated cash flows discounted at the money cost of capital of 8% per annum. However, because of the nature and size, a rate will be increased by 2%, therefore we have to use 10%. Though no rationale is given, okay, you would see that this is a requirement of the question. Discuss why the 2%. Right, it depends on the risk. The business risk is changing. You need to use a project specific discount rate, but for the time being, just know that we have to use a discount factor of 10%. So discount factor at 10%. So you're going to get that in the net present value table, 0.826, 0.751, 0.83. Right, so this is just show you in a while where you're going to have this. You will see that in the software, somewhere in here, you're going to have what is known as the list of formula and tables. You click on that, you will have this table presented to you, and then you are going to choose, you will choose the, here you go, you're going to use 10%, 909, 826, 751, and 683, right? So this is where you're going to get that. We're going to include a bottom line again, and then we are going to calculate the PV, which is equal to this one. Again, you have to do one by one. You can't drag the formula, you can't copy and paste formulas in this software, so you have to calculate them individually. So if you want to calculate the NPV, so this would be the sum of it. If you select them again, include a bottom border, and then calculate the auto sum, you would see that if it is aligned in a horizontal way, the sum will be in a horizontal way as well, right? So this is the NPV, and then we are going to write it down here. So NPV equal to this value. You would see that the NPV is positive, so always write this line to conclude the question. Given that the NPV is positive, the company should accept the project as it will increase shareholders' wealth. Yep, here you go. So that's it for this question, which is about point A. A complete question on inflation and tax and capital allowance on working capital, where it says advise whether it should accept the project. This is a 16 marks question. Thank you. More questions to follow soon.